In theory, trading crypto is one of the fastest ways to make life-changing money. Some traders have turned just a few $100s into millions in a matter of days. In practice, however, most traders end up losing, and some lose everything in minutes. That's because crypto trading is not like trading other assets. Today, I'm going to walk you through everything you need to know about trading crypto from square one. By the end of this video, you'll have the knowledge to start with confidence. The reason crypto trading can be so profitable comes down to one factor: emotions. Crypto is incredibly volatile. It's normal for prices to rise or fall by 10–30% in a single day. To put that into perspective, if a stock moves more than 5% in a day, it's considered extremely volatile. In crypto, a 5% swing can happen in minutes, sometimes even seconds. That speed of movement makes people emotional, greedy when prices rise, fearful when prices fall, and believe it or not, this is the foundation of trading itself. When people feel greed, they buy. When they feel fear, they sell. Those emotions create repeating patterns on the chart, and price action follows. The first person to document this was a Japanese rice merchant in the 1700s named Homa Munehisa. He invented candlestick charts, which we still use today, and identified that fear and greed leave patterns that repeat over time. These patterns show up in every market: stocks, commodities, and now crypto. The difference is that in crypto, emotions are stronger because the market is filled with new traders chasing quick riches, alongside whales who manipulate them. This makes the patterns more obvious, but also more dangerous, because the whales know technical analysis too. As legendary trader Richard Wyckoff once said, "All the fluctuations in the market should be studied as if they were the result of one man's operations, the composite man, who manipulates the market to your disadvantage if you don't understand the game, and to your great profit if you do." So let's start with the basics. Before trading anything, always look at Bitcoin. BTC leads the market. If it's rallying, other coins usually rally. If it's crashing, almost everything follows. Open a BTC chart, remove all indicators, set it to the daily time frame, and zoom out. Each candle represents one day: green for an up day, red for a down day. Large bodies with small wicks show strong momentum. Long wicks show rejection and potential reversal. For example, long wicks on top suggest heavy selling pressure. Long wicks on the bottom suggest strong buying. If candles are shrinking in size, it often means a trend is running out of steam and could flip soon. Once you've identified whether BTC is trending up or down, the next step is to find key levels. These are price areas where BTC has repeatedly bounced, support, or been rejected, resistance. They're often around round numbers like 25K, 30K, or 100K. BTC tends to chop between these levels, and when one breaks, it often retests before continuing. For example, if BTC breaks above 30K resistance, it might pull back to retest 30K as support before moving toward the next level. The distance between levels can also give you targets. If BTC was stuck between 28K and 30K, that's a 2K range. A breakout above 30K could target 32K, while a breakdown below 28K could target 26K. Now let's add some simple technical indicators to refine our analysis. Volume shows whether a move is strong. Rising volume confirms trends. Falling volume suggests weakness. RSI, the Relative Strength Index, helps identify if BTC is overbought or oversold. If it's too high, a pullback is likely. If it's too low, a bounce could follow. MACD, the Moving Average Convergence Divergence, helps spot momentum shifts. When the bars are green, trend is positive. When they're red, it's negative. When the lines cross, it signals a potential trend change. Two more powerful tools are moving averages and Bollinger Bands. The 50-day and 200-day moving averages act as hidden support and resistance zones. When the 50-day crosses above the 200-day, it's called a golden cross, a strong bullish signal. When it crosses below, it's a death cross, a bearish one. Bollinger Bands, on the other hand, show how far price could stretch in the short term. The middle band is like a moving average. The outer bands expand and contract based on volatility. If they squeeze tightly together, it often signals a big move is coming. Everything I've just explained for Bitcoin applies to altcoins too. But here's what you must remember: the smaller the coin, the easier it is for whales to manipulate. Large altcoins are also risky because leveraged trading creates sudden spikes and crashes, short squeezes, and liquidation cascades. That's why if you're just starting out, you should avoid leverage completely. Instead, practice by tracking trades on paper or in simulation. Once you can consistently find setups that work, then you can start risking small amounts of real money and scale up over time. And finally, patience is everything. Not every trade plays out in minutes or hours. Some take days, weeks, or even months. The hardest part is waiting for your targets to be hit instead of exiting early out of fear or greed. The real secret to success isn't trading all the time, it's waiting for the right setup, taking the shot, and then letting the probabilities play out. Quality always beats quantity.
Welcome to Nomad Money, your go-to community for smart, clear trading strategies. Whether you're just starting or experienced, we provide real-time insights and tools to help you trade smarter, not harder. Join our supportive network, learn from experts, and reduce guesswork with our proven methods. Plus, don't miss out on our free Telegram group where you get exclusive tips and live support. Trade with confidence, trade with Nomad Money.